So I think if we look at the long term, one of the key messages from this year's long-term capital market assumption is really we're starting with a very healthy foundation. So we still expect the growth outlook to be pretty robust. As you mentioned, we think AI adoption is likely to boost productivity, and we also think the desire to invest both from the private sector as well as from the public sector will come back to continue to support growth. As you mentioned, our kind of forecast for the next 10 to 15 years, the annualized return for global equities slightly lower in this year's edition for the next 10 to 15 years, but it is because it's a very high starting point. There's no denying that we had a very strong year for global equities, up 30% also year to date. So I think even with that higher starting point, higher starting level of valuation, because of the robust growth outlook, we still think risk assets can have a relatively robust return environment in the next decade and a half.
Yeah, you mentioned a key word here, artificial intelligence, as of course we were watching the fireside chat taking place in Japan. Which countries, which locations will be set to benefit from that?
So we still think it's predominantly probably DM economies first, because they are at the forefront of the technological frontier. And especially when we look at markets, we still think the higher concentration of technology companies in the U.S. probably means U.S. large cap is likely to benefit the most.
Sylvia, interested in picking your brains about your projection for the Chinese market with a 7.8% return next year. Can you talk to us about what's going to largely drive that?
Yeah, so basically the 7.8% is our forecast annualized return for the next 10 to 15 years. And a big chunk of that is really coming from the revenue side, where we continue to expect kind of revenue growth because China is still growing at a relatively fast clip. And some of that margin improvement, we do think are currently at current levels, margins is still on the relatively low side compared to long-term fair value. So we think margins will have a kind of boost to overall expected returns as well. Valuation, not that high at the moment, even though when we did our numbers, it's really kind of after the rally, so end of September. So not too much valuation improvement. I think with current valuations, there's also room for that to improve. So strong revenue growth, margins improvement, and also about valuation tailwind as well.
Of course, this is a long-term look at investment and the assumptions, but how does geopolitics or political change, how is that incorporated into your findings, even if it's just for 4 years? And I'm specifically referring to Trump in office.
Yes, so I think a lot of the themes we've been talking about in our long-term capital market assumptions very much ties into the discussions we've had over the last week. So this whole kind of shift from monetary activism to fiscal activism, so more focus on fiscal spending, doing the heavy lifting in the economy, and also economic nationalism. Obviously, there could be good or bad, but I think so far it's more focusing on supply chain resilience. So a lot of that is already captured in the report from longer term basis, and we're capturing it through kind of higher inflation volatility, potentially policy volatility as well in our numbers.
And you mentioned policy, and I want to ask you about the outlook on interest rates. What does it tell you in a longer term view?
So from a longer term perspective, we do think because of the shift to a more robust growth outlook as well as more active fiscal policy, we have actually increased our cycle neutral, or you can think of a fair value cash rate for the U.S. over the next 10 to 15 years from 2.5 to 2.8%. So you do see that we do expect a return to a more normalized real rate environment in the U.S., more like a pre-GFC kind of environment of positive real yields.